Hello and welcome to Intermediate Accounting 2, Chapter 22, Cash Flows. So for this chapter, what we're going to do is we're going to look at the purpose of cash flows, the classification of cash flows. So where does each number go and which type of classification? There's three of them. The cash flow format. So there's two different types of formats. There's the direct method and the indirect method. So we're going to go through both of them, and you want to make sure that you know how to go through both methods because both can appear on an examination. All right, so the statement of cash flows is basically shows you the flow of cash. So it shows you how you spent or how the company spent their cash during the year. Okay, so what type of activities was it spent on? What was your beginning cash? What was your ending cash? And what did you do in between in order to go from the beginning to the ending? So the users would like to know what you're doing, what the company is doing with all the cash. So shareholders or creditors, investors, maybe even employees would like to know how the cash is being flowing, and management would like to know that because they want to make sure that they can control cash, because cash is really important asset on their books. They want to make sure that they're controlling it and not wasting too much cash. So a cash flow statement will let them see what are they spending on and what should they be spending on. So the purposes are to determine the liquidity and solvency of the company. So how liquid is the company? Is there enough cash to pay all the liabilities that they need? It also looks at what happens in the future. So what's happening now will help you kind of get an idea of the amounts and timings of future activities, and helps with any uncertainties about future cash flows. It also helps determine what the difference between net income and your cash. So if you get a bunch of cash, that doesn't necessarily mean that your net income is going to flow the same way. So it's a good way to determine why is there a difference between net income and my cash flow. So classifications of cash flow. So there's three different activities that cash will go under. So when you're doing the direct method or the indirect method, there's three different areas, and you have to put the different numbers from your balance sheet and income statement into these three different activities. So there's operating activities. These operating activities are your income statement items. So all your revenue and expenses will go into your operating activity section. And then any changes to your non-cash current assets and current liabilities, so this should say current liabilities, would go into your operating activities. So the change from prior year to this year, so if this year is 2020, so basically just the change from 2020 to 2019. So the difference between 2020 and 2019 on your non-cash current assets and current liabilities are going to be included in operating activities as well. Okay, so if you look at the statement of financial position and the income statement, all those amounts need to go somewhere in the cash flow because they're going to affect the cash flow. So all your revenue and expenses go into the operating activities, and all your changes from current year to prior year of current assets and current liabilities. So operating activities are your day-to-day activities. So that's obviously related to your income statement because your revenue and expenses are your day-to-day things that are happening. Investing activities is your second kind of section that you would put something in your cash flows. Investing activities deal with the acquisition and disposal of long-term assets and other investments. So what you're going to do when you're looking at what to put in investing activities, you're going to put any changes in your long-term assets. So anything from 2020 minus 2019. So the differences between 2020 and 2019 will show whether you acquired some assets or whether you disposed some long-term assets. Okay, so anything you want to look at your long-term or your long-term asset section to determine what will go into the investing activities. And then the third one is financing activities. So financing activities deals with issuing and purchasing the company's own shares or obtaining debt. So here, what you want to look at is your change in your long-term liabilities and your equity account. So long-term liabilities and equity account will go into your financing activities. So basically what we have done is split up your balance sheet and income statement into 3 different areas. So all income statement items will go into operating activities. Your current assets, current liabilities will go into operating, long-term assets into investing, and long-term liabilities and equity, that should be R here, long-term liabilities and equity will go into financing activities. Okay, so that's how you split that up. Okay, one kind of caveat to this is when you look at interest income and interest expense. So where do you put the interest income and interest expense? Do you put it in the income statement items because it's part of revenue, it's part of expenses, it's part of revenue and expenses, or does it go into investing activities because it deals with, it has to do with investments and it has to do with obtaining debt. Right? So that's that could be a bit confusing sometimes of where that one. There's also an issue of where do dividends go? Dividends paid or dividends received, right? So dividends received would go into your revenue, but would they be part of financing activities? Okay, so there's just a couple little nuances into this. So there's a little bit of a difference between ASPE and IFRS and how to deal with interest and dividends. So interest and dividends paid, ASPE says go into operating activities if it's recognized in net income, or they'll go into financing activities if it's charged to retained earnings. Okay, so basically, if it's part of net income, then you put it in operating. If it's part of retained earnings, then that's part of equity, which goes into financing. IFRS says that there is a choice. You can either put it in operating or put it in financing. For interest and dividends received, ASPE says put it in operating. Okay, so interest and dividends received, interest income or dividends received, dividend revenue goes into operating activities. Oh, sorry. IFRS, you have a choice between operating activities or investing activities. Okay, so just keep that in mind for interest and dividends because it doesn't always follow that format that I showed you, or the classifications that I showed you. All right, so let's go to question 1. So if you open up your Excel, chapter 22, class exercises, I'm going to see we have 3 questions here. The first question talks about classify items as either an operating, investing, or financing activity. And if it's an investing or financing activity, think about whether the activity is going to increase or decrease cash flows. So what I want you to do now is pause this video and attempt this question on your own and think about, if you're looking at my split in the PowerPoint, try to figure out where all these activities are going to go, either in operating, investing, or financing. And if it's investing or financing, is it going to increase or decrease cash? Okay. And then you can unpause when you want to look at watch the take up, which we will do right now. So purchase of equipment. So if you just think about purchase of equipment, where does that fall into? Does that fall into your income statement? So maybe if I just have the, I guess, the sections right now. So you either have your income statement, you have your current assets and current liabilities, you have your long-term assets, you have your and then you have your long-term liabilities, and then you have your equity section. So any income statement items will go into operating, current assets, current liabilities into operating, long-term assets into investing, long-term liabilities and equity into financing. Okay, so this could be like your little cheat sheet to be able to tell which activity it is. So purchase of equipment is in long-term asset, so it's going to go into investing. Okay. And if you're purchasing equipment, you're going to pay cash, so that cash is going to decrease your income. Sale of a building, same thing. The building will be in a long-term asset, so it's investing. And if you sell a building, you're going to make some money, so you're going to get cash. So that's going to increase your cash. Depreciation of equipment. So where does depreciation go? If you look at depreciation expense, it goes into operating. It goes into your net income, which is an operating. Issuance of common shares. So when you issue common shares, it's going to be part of equity. So that's financing. Amortization of intangible assets. So same thing as depreciation expense. This would be amortization expense. So operating. Oh shoot, we didn't, just going back to financing to see if it's increasing or decreasing cash. So if a company issues common shares, that means they sell common shares and then the shareholders buy them and pay cash. So that's going to increase your cash. Purchase of a company's own shares. So if you remember from intermediate accounting 2A, when you purchase, sometimes companies will purchase their own shares back. So that would also be part of equity because it's in the shareholders equity section. And if you're purchasing shares, you're paying money for them, which is going to decrease your cash. Impairment loss on goodwill. So that's similar to your depreciation expense, amortization, and then impairment loss will go into operating. Unrealized holding loss on investment accounted at fair value with gains and losses in net income. Okay, so if it's inside net income, that's going to be part of your income statement, so it's operating. Next one, increase in interest receivable on notes receivable. Okay, so under ASPE, this would go into operating. Under IFRS, you have a choice between operating or operating or investing. It doesn't really tell us whether this is ASPE and IFRS, so let's just be safe and put it in operating. Okay, so IFRS, you have a choice between operating and investing for this one. Pension expense in excess of the amount funded. So pension expense is part of your income statement. So that would be operating. Payment of monthly finance lease obligation. Okay, so sorry, this should say capital lease. So, payment of monthly capital lease obligation. So if you remember from chapter 20, when there's a payment, if you have a capital lease and there's a payment, where does that payment go? Okay, so try to remember with the journal entry. So whenever there's a payment, we're actually going to debit our lease obligation, credit our cash. So if we're debiting our lease obligation is probably a long-term liability because it's longer than 1 year of a lease term. So it would go into financing. And if you're paying something, that means your cash is going to go down, so decrease. Payment of an operating lease agreement. Okay, so capital lease, that's going to bring down your lease obligation. If you have an operating lease, think about what the journal entry is. You're going to debit your lease expense and credit your cash. So lease expense is part of operating. And then the last one, payment of principal on an operating line of credit. So line of credit would probably go into your long-term liabilities. So that would be financing. And if you're paying something, you're decreasing your cash. Okay, so first step for cash flow statement is first to figure out what type of activities there are, because you need to make sure you put them in the right section. And then you can move on to actually creating a cash flow statement, which we'll talk about now. All right. Okay, so the format of cash flow statement. So there's two types of methods in order to show the cash flow. Both are acceptable methods under ASPE and IFRS. In practice, a lot of companies use the indirect method because it's probably just the easier method to do. But people say that the direct method provides better information to the financial statement users, but the indirect method is an easier method to apply. So like I said, make sure you know both methods. The direct method, what it does is it shows all the cash receipts and adjusts those for any non-cash items. And then it shows your cash payments individually and then adjusts them for any non-cash items. And that's going to give you your cash flow. The indirect method starts with net income and then adjusts for any non-cash items. Okay, so the direct method pulls out certain aspects of the income statement and kind of deals with it separately. The direct method just takes your net income number and then just adjusts it for any non-cash items. So the difference between the direct method and the indirect method is only for your operating section. So your operating activity section, that's when you're going to have a difference between the direct method and the indirect method. For the investing and financing activities, for those two sections of the cash flow, there is no difference between the direct method and the indirect method. So the only difference you're going to find with these two methods is within the operating section. Okay. So financing and investing, you do the same way, whether it's direct method or indirect method. So I just pulled up the cash flow statement of Air Canada, and just looking at this cash flow statement, I just want for you to figure out what type of method are they using. Are they using the indirect method or are they using the direct method? And to answer this question, we would just look at the operating section, because the financing and investing section, we would just, both methods would lead to the same result. So you just do the same thing. So here they started with net income and then they made adjustments. They made adjustments for any non-cash items and the changes in working capital accounts. So changes in your current assets and current liabilities. So this is actually using the indirect method because they're starting with net income. So then they're looking at their operating. So they kind of split everything up. They total up their cash flows from operating. Then they move on to financing. Total the cash flows from financing, then they move on to investing, total that up, and then at the end, you're going to show your decrease in cash, and then you're going to show what you began with, plus so decrease or increase in cash, whatever the total shows. And then what you began with, add your decrease or increase in cash, and that should give you your ending balance of cash. You want to make sure your ending balance of cash aligns with what your balance sheet shows as your cash account. All right, so for the direct method, let me show you how you do the direct method. So you're going to split, for your operating section, you're going to split everything up. So cash received from customers. So that's like, I guess, the first section of your operating activity section. So you're going to write cash received from customers. And then you're going to put in your revenue amount. Okay, so first part of the direct method, cash received from customers, and you're going to put in your total revenue. But you know this total revenue doesn't equal the total cash, right? So this revenue doesn't actually equal the total cash that the company got, because the revenue items could include some accounts receivable amounts. Right? When you're doing the revenue recognition, when you're doing the revenue journal entry, you either debit cash or AR, and then you credit revenue, right? So this is not all of the cash. So we need to take in the change from current year and prior year of the accounts receivable to only get what is the cash amount in this revenue. Okay, so if your accounts receivable increased from the prior year, right? So if it's higher than the prior year, that means you didn't get the cash, right? Because if it increased, if accounts receivable went up, that means you didn't collect the cash. So you would have to subtract any increases from the current year and prior year would be subtracted from the revenue account in order to get the actual cash received from customers. And then if accounts receivable went down in the current year from the prior year, then that means that if accounts receivable goes down, what's the journal entry? So the journal entry, we're going to debit cash and credit AR, which means we got cash. Okay, so if we got cash, we're going to increase our cash flow amount. So any increases in accounts receivable from prior year to current year are going to be subtracted from revenue, because that means that you didn't get the cash, but any decreases in accounts receivable means you would have gotten the cash, so you're going to add that to the revenue amount. The next, I guess, like subsection is your cash paid to suppliers for goods and services. Okay, so cash paid to suppliers for goods and for services, you're going to pull out the cost of goods sold amount and the operating expenses from your income statement. Okay, so we're basically doing this in steps. First thing you're going to deal with is the revenue amount. Next thing you're going to deal with is your cost of goods sold and operating expenses. So cost of goods sold, what's related to that is inventory. So changes in inventory from prior year to current year. If inventory has increased, then you would subtract that. If inventory has decreased, then you would add that. Okay? So if inventory has increased, what would be the journal entry? So you would debit cash and you would credit inventory. Oh, sorry, other way around. Because, let me just erase that. Okay, let's do it the other way. So you would, if you bought inventory, one second. Okay, so if you bought inventory, you would credit cash and debit inventory. Right? So if you bought inventory, and we won't worry about accounts payable. Accounts payable is going to be dealt with here. So we won't even have to worry about that. So we would debit inventory, credit cash. Okay? So if inventory is increased, that means we would have paid cash for it. So we have to deduct that amount. Same thing with change in prepaid expenses. If prepaid expenses go up, we're debiting prepaid expenses and crediting cash. So we have to subtract that from our cost of goods sold operating expenses amount on the income statement. And if we're decreasing prepaid expenses, then we're going to add that because that means we brought it into our expense account, operating expenses or cost of goods sold. Before moving forward, I just want to note that so your revenue is going to be a positive amount because you're getting cash. Your cost of goods sold is going to be a negative amount, right? So there's brackets to show that it's a negative amount. So make sure you have it as a negative amount so when you add everything up at the end, you have the correct signs. Changes in accounts payable. So if accounts payable increases, what does that mean? If accounts payable increases, that means maybe you paid for an expense, right? So you would debit an expense account and you would credit accounts payable. There's no cash, right? There's no cash happening here. So, but the expense is part of these operating expenses. No cash, so you would actually add that amount. If accounts payable has decreased, that means we're going to debit accounts payable and we're going to credit cash, right? So cash has gone down in this case, and therefore we have to subtract that amount. So just looking at this, basically your assets, so like the general rule is any changes in your current assets, if there's increases in your current assets from last year or this year, you're going to subtract that amount. Okay? If there's decreases, you're going to add that amount. It's the opposite for current liabilities. For current liabilities, if current liabilities have increased, we're going to add the amount to our cash flow. If current liabilities have decreased, we're going to subtract the amount from our cash flows. If you remember this general rule, then you will have no problem doing the operating activity section. The same rule applies when we're looking at the indirect method. So make sure that you know if current assets go up, that means you're subtracting the amount. If current assets go down, you're adding the amount. If current liabilities go up, you're adding. Current liabilities go down, you're subtracting. So basically you're doing the opposite. Okay, so if you remember this, then you will be fine. Okay, so just get this into your head. All right, moving on. So we've dealt with revenue, we've dealt with cost of goods sold and operating expenses, but we have other expenses on our income statement. So you have to deal with each one of those expenses separately. So another expense is salaries and wages expense. So another section So part 3, I guess, cash paid to employees. You're gonna take out your salaries and wages expense. And again, this is in brackets, so that means it's a negative amount. And what's related to salaries and wages expense is salaries and wages payable, right? That's the working capital account that's related to this expense. So if salaries and wages payable increased, we're going to add that amount. If it decreased, we're going to subtract the amount. The same logic applies here. If you decrease your salaries and wages payable, you're debiting salaries and wages payable, which means you would have credited cash. So if cash goes down, you're going to decrease the amount. Next one, cash interest paid. So cash interest paid, you're going to bring out your interest expense from the income statement. And then any changes in interest payable, again, same logic here because it's a liability, increases are added and decreases are subtracted. Okay, so if your interest has gone down, interest payable account has gone down from last year, that means you would have paid the cash. And then number 5 is your income taxes paid. So take your income tax expense, and then that's related to income tax payable. So again, same thing, any increases from last year to this year of income tax payable gets added, any decreases get subtracted. Right? So basically what we're doing here is we're taking the sections from the income statement and we're taking them separately, and then we're going to look at what working capital account, so what current assets or current liabilities are related to this this account, and then we're showing what happened with it, whether we're going to add some more amounts or subtract some more amounts. All right, for financing and investing activities under the direct method, it's not related to income statement items, so we don't have to like pull those out and figure out the working capital accounts. So the way that we do investing activities and financing activities is pretty straightforward. So if cash was paid, we're gonna decrease, right? So if cash was paid, we're gonna subtract cash. So we're gonna subtract the amount. So if cash was paid, if cash was received, that means cash went up, so we're gonna add the amount. Okay, so that's pretty straightforward. And for investing activities and financing activities, the same way you do under the direct method, you do it under the indirect method. All right, so let's try question 2, part A. So if you go back to your Excel, we'll try doing part 2. Or sorry, question 2. All right, so we have the following information here. We have the income statement. It says there was no purchases of sale of the trading fair value net income investments in 2014. And we have the statement of financial position information. So this is the we just have our current assets, current liabilities. It says to prepare the operating section of the statement of cash flows using the direct method. Right, so what I would like you to do now is pause this video and try this question on your own, and then you can unpause and look at the solution. Okay, so let's do the take up. So for the direct method, we're looking at the income statement and we're pulling the necessary information from there. So we're going to start with our sales revenue amount. Okay, so we're going to say cash received from customers. 778. Okay, so cash received from customers is 778. Then we're going to adjust this for accounts receivable. So let's look at what happened to accounts receivable. So if you just, I just did these totals here, like to look at the change. So current year minus prior year gives you the change in each of these accounts. And so current year, so 35,000 minus 54,000 gives us a negative 19,000. So for accounts receivable, we know that there has been a change and it's gone down. So if accounts receivable has gone down from prior to this year, that means we would have received cash. So that's going to increase our cash. So we're going to add the amount for the adjustment of AR, or the change in AR. And then we can do a subtotal here. So we can do 778 plus the 19,000 gives us 797 for cash received from customers. Next thing we're going to do is look at cash paid to suppliers for goods and services. So it doesn't look like we have cash paid for goods here because we don't have a cost of goods sold. So this seems like a service company. So it doesn't have any inventory here or cost of goods sold. So we're just going to take this operating expenses amount. So operating expenses is an expense. So that means it's going to be a negative amount. So 499,000 negative here is cash paid to suppliers for goods for, well, it'd just be for services in this case because there is no inventory. And then we're going to adjust this for, usually if there was cost of goods sold included in here, you would adjust that for your inventory amount, which we don't have. We're also going to adjust it for any prepaid expenses. So just looking at our statement of financial position, we don't have any income. We don't have any prepaid expenses, but we do have accounts payable. So it also needs to be adjusted for accounts payable. So accounts payable was 44,000 this year, 31,000 last year. So it went up by 13,000. So if it went up, that means we didn't pay the cash. So we're going to add this 13,000. So we're going to take the 499,000, add 13,000, and then our subtotal here becomes negative 486,000. So negative 499 plus 13,000 gives us negative 486,000. Next one we're going to look at, so we don't have any interest expense here. So we're not going to pull that amount. What else do we have? So when you're looking at the income statement to see which amounts to pull, so we got sales revenue already, we got operating expenses already. Depreciation expense, are we going to add this into our cash flow account? You're going to only add things that have a cash component in it. Depreciation expense, there is no cash component in it, so we actually don't add this. Unrealized loss on sale of fair value net income investments. There's a note that says there were no purchases or sales of trading fair value net income investments during 2014. If you remember from your previous accounting courses, an unrealized loss on fair value net income investments is basically just updating the investment account. So probably under your long-term asset account. Actually, we have it right here. So it's just updating your investment account to whatever the fair value is in 2014. Okay, so this you would have, so here what they did is from 2013 to 2014, the fair value went down by 4,000. So the journal entry would have been to debit the loss and credit the fair value net income investment asset account. Okay, so there is no cash involved with that. The only time cash would be involved with investments is if you bought or sold the investment during the year. And that would go into the investing activities, not the operating activities. Okay, so we're not going to add this to our cash flow account. We're only adding things that have that affect cash. Loss on sale of equipment, same thing. If there's a loss on sale of equipment, this loss isn't the amount of cash that you're getting. So this wouldn't be included in your operating section. What would be included is under the investing activity section, you would include how much money you got from selling the equipment. So you wouldn't even include this loss at all. And then that gives you net income before tax, and then there's income tax expense. So income tax expense, there is a cash component here because you're paying the income tax. So this we can include, it's a expense, so it's going to be a negative amount. Okay? So cash paid for income tax, negative 58,000, and then we're going to adjust that for our income tax payable. So we went from 8,500 to 6,000 for income tax payable. If a payable amount has gone down, that means we paid cash. So the difference between those two amounts, the 2,500, we have to subtract from our cash flow statement. So subtract the 2,500. 58,000 is already a negative 58,000 plus a negative 2,500. It gives us a negative 60,500. Then we can add all these three up: cash received from customers, adjusted for AR, cash paid to suppliers, adjusted for accounts payable, cash paid for income tax, adjusted for tax payable. And if we just add all these up, then the net cash provided by operating activities is 250,500. Okay, so that's how we have to deal with the direct method. Anything that affects cash on our income statement, we have to move it into the direct method under its own kind of section, and then adjust for any working capital accounts, any current assets and current liabilities that relate to the amount on the income statement. Okay, so I hope that makes sense. We didn't have to do the investing section, we'll do it, or the financing section, but those are straightforward. I'll show you that in question 3 when we get there. But what I want to do next is go through the indirect method. So the indirect method, this time we're starting with net income. So we're not actually pulling different things from the income statement like the direct method is doing. We're only pulling the income, net income, from the operating section, and then we will adjust the net income for any non-cash items. So what we're going to do is we're going to add back any expenses or losses that are non-cash. So for example, we saw that depreciation, right? So depreciation would be a non-cash item. Amortization expense would be a non-cash item. Impairment loss. So any non-cash items here. Any losses on like selling assets. Okay. Any unrealized loss on investments. All those would be any non-cash items. So you start off with the total net income amount, and then we're going to add back any expenses or losses that are non-cash. And then we're going to deduct any income or gains that are non-cash. Okay, so having, like, for example, having a gain on selling assets, or an unrealized gain on your investments. Okay, so we start off with a total net income, but we know that there's going to be non-cash items in there. So we add back any expenses and losses. We deduct any income or gains that are non-cash. And then the second thing you have to do is changes in your non-cash working capital. So same thing as we did with the direct method, we're going to add back our current assets that have decreased and our current liabilities that have increased, and we're going to deduct our current assets that have increased and our current liabilities that have decreased. So same thing we do with the direct method. So if current assets, so maybe remember my cheat sheet, I'll bring that back up. So if current assets have gone up, we're going to deduct that amount. If current assets have gone down, we're going to add that amount to our cash flow. For current liabilities, we do the opposite. If current liabilities have gone up, we add that amount. If current liabilities have gone down, we deduct the amount. All right, so let's try to do that. Let's go back to our question 2, part B. We'll try to do that, and then we can do question 3 as well. All right, so if we go back to our question 2, we're going to try to do this again using the indirect method. So pause this video, attempt the indirect method for the operating section, and then you can unpause to listen to the take up. All right, so the indirect method, we start with net income. Okay, so we're just going to start with this net income number, 137, and that's going to be a positive amount because it's a net income. If it was a negative amount, it would be, if it was a loss, it would be a negative amount. Then we're going to deal with any non-cash items first. So if we go back to our income statement, we know that depreciation expense is a non-cash item. So depreciation expense was decreased the net income. So to take out depreciation expense from net income, we have to add that back. So we're going to add the 66,000 right here. So add that one back. We have an unrealized loss on fair value net income investments. This is a non-cash item because you didn't actually you didn't lose $4,000 of cash. So we're going to add that one back, 4,000. And then loss on equipment. Again, like I said, we did not get $14,000 of cash, so that's a non-cash item. So we have to add that one back as well. We don't have any like income or gains that are non-cash, so we don't have to worry about that. Okay. Next thing, we have to look at the changes in working capital accounts. So your change in working capital. Your fair value net income investments is non-cash, not part of the working capital. But we have our accounts receivable. Our accounts receivable went down. That means we got cash. So we're going to add the amount. Okay, so we're going to add our decrease in accounts receivable. Accounts payable went up. So that means we didn't pay cash. So we're going to add that amount. So we're going to add the 13,000. And then our decrease in income tax payable went down from prior year, which means that we paid some cash to bring down our payable amount. So we have to subtract the 2,500 from our cash flow. Right, so if we start with 137, we add and subtract these items. The total here, just to show you the total. So the total is 250,500. Net cash provided by operating activities, and it is the same total that we had when we did part 1 or part A, which was net cash provided by operating activities using the direct method. So whether you use the direct method or the indirect method, your total at the end, your net cash by operating activities should be the same for each one. So there's just a different way of getting there, but it's going to be the same amount. All right, so let's try question 3. So question 3 kind of looks at, we have a statement of financial position from 2020 and 2019. We have our, this should be our income statement. We have an income statement from 2020 and the two questions, we have some other information. So this other information is important because it kind of gives you better information on what we do with this. Okay, so the two things we have to do is figure out, do your cash flow statement using the direct method, and then do the cash flow statement using the indirect method. So you want to do all three, the operating section, investing section, and your financing section. All right, so what you want to do now is pause this video, try doing this, and the total of everything, so the total change in your operating, investing, and financing activities, the total change should be 13,250 because that's what the cash says, right? So you can double check if you did it right, because it should, if you add up the net cash provided by operating activities, net cash provided by investing activities, and net cash provided by financing activities, that total should be the increase in cash of 13,250. Okay, all right, so go do that on your own, and then you can unpause the video when you're done so you can look at the take-up. Okay, so let's take this up. So first thing I would do is just look at the change. So I'm just going to do a 2020 amount minus 2019 amount, and I'm going to go do that for the full financial statement, for the full statement of financial position, just to see, just to get that out of the way first, because it's just easier for me to do my work, okay? So because we need the changes in those accounts. All right, so direct method, we're going to start with your income statement. We're going to start with our sales amount, okay? So you're going to start with your revenue amount using the direct method. Okay. So cash received from customers, it's your revenue amount. And then from that, what you're going to do is look at what the change happened in AR. So accounts receivable went from 55,600 to 74,800. So it increased by 19,200. An increase to accounts receivable means that the company did not get cash, so we have to subtract that from our revenue amount. So the 19,200 is subtracted, and we have our net amount there. Next one, cash paid to suppliers for goods and services. Okay, so I guess what we should do is read some of this other information to see if it applies to any of these amounts first. So this is talking about plant assets costing $95,000 were purchased. They paid $44,000 and issued 5,000 common shares. The other expenses relate to prepaid items. Okay, so other expenses relate to prepaid items. So that should be part of our operating expenses. There were no penalties assessed for the retirement of bonds. Okay, so we know that interest expense doesn't include any penalties or anything like that. And the last note says cash dividends of 78,000 were declared and paid at the end of the fiscal year. So in ASPE, you would put this under financing activities if it affected retained earnings. And then in IFRS, you have a choice between operating and financing. So in this case, we'll put it under financing, and I'll show you when we get to that section. Okay, so under the direct method, the second thing to do is cash paid to suppliers for goods and services. So if we go back into our income statement, we do have cost of goods sold this time. This number needs to be a negative because it's an expense. Okay, so we have that. And then we also would include operating expenses here. In this case, we know we're going to treat salaries and wages in a separate section. This other expense, we know it relates to prepaid items, and we know prepaid expense is something that we're going to adjust for in the cash paid to suppliers. So we're going to include this other expense into that as well. So 24,800 negative again. So we're going to include that. And then we're going to adjust these two amounts for any changes in the working capital accounts. So we do the inventory change. Okay, so because cost of goods sold and inventory are related. So inventory went down by 10,300. If inventory went down, that means it went into cost of goods sold. So we're going to add that back. So that means we didn't buy new inventory at the end. So we didn't have to pay cash on that. So we're going to add that back. We're going to have prepaid expenses as well. So prepaid expenses went up by 1,800. If prepaid expenses went up, that means we paid cash. So we would have to deduct that amount, 1,800. And then accounts payable. Accounts payable went up by 8,000. If accounts payable went up, that means we did not pay that cash. So therefore, we can add this $8,000. All right. And then the subtotal for all of these would be negative 822,300. Next thing we're going to take out of our income statement is cash paid on behalf of employees. So that's when we do our salaries and wages expense. So that's kind of a separate line item. And it's an expense, so it's going to be a negative amount, so negative 207,800. And then related to that, we have our salaries and wages payable. It went down. So if salaries and wages payable goes down by 11,000, that means we paid the cash. So we have to deduct that 11,000. Okay, so then in total, we have 218 there. Cash paid for interest. We're going to look at, so depreciation, we don't have to include because it's a non-cash item. Cash paid for interest, 66,700. It is an expense, so it's a negative number. And then we go to our interest payable. This went up by 2,100. If it went up, that means we did not pay cash. So therefore we would add that amount, 2,100. Okay. Add those, subtotal those, and we get 64,600. And the last one, cash paid for income tax. So we have here income tax expense, 65,400. So it's a negative again. And then let's go look at income tax payable or income tax receivable. Doesn't look like we have either. We don't have income tax payable or receivable. So that doesn't need to be adjusted by anything. So we have 0. And then we're going to add up all these amounts, and we're going to get the net cash flow from operations or operating activities is 155,500. Okay. So that is the direct method way. Let me show you the indirect method way, because we're still on the operating expense, the operating activities, and then we'll go through the investing and financing. Okay, so let's do the two different methods under under operating activities. For financing and investing, it doesn't change. So let's try this. Okay, so under the indirect method for operating activities, you start with your net income amount. Yes. So we have a net income here of 141. So we're going to 141, 100. So we're going to start with that amount. Then we're going to adjust this for any non-cash items. So if you're looking at the income statement, trying to figure out if there's any non-cash items, you want to look at the notes as well to see if the notes show that, you know, something is a non-cash item that's included, like maybe in other expenses. In this case, other expenses relate to prepaids. That's not a non-cash. The only non-cash thing we have here is depreciation. So we're going to add back this 26,000 of depreciation. Yeah. And then we're going to look at the changes in our working capital account. Okay, so we're going to go back here. Anything, our three current assets are going to be adjusted. So we talked about why we add and subtract. So basically the 19,200 we're going to deduct. The inventory we're going to add. Prepaid expenses we're going to deduct. So basically what we did for the direct method, whether we add or subtract, whether we deduct or add, we're going to do the same thing. Right? So deduct the AR, add the inventory, deduct the prepaid expense. And then on the liability side, we have our three liabilities here. We're going to add the accounts payable, deduct the salaries, add the interest payable. Okay, so where are we? Okay, so add the accounts payable, deduct the salaries and wages, add the interest payable. So if we take our net income, and after all these non-cash items and changes in working capital, that gets us 14,400 we have to add to our net income, and the net income for the operating activities is 155,500. Okay, so this should be the same as our cash flow from operating activities when we did it with the direct method. So indirect method or direct method should come up with the same result. Okay, next up, we'll go look at the investing activities. So when you're looking at the investing activities, you want to look at this other information because that will give you some guidance on how to do it. But we're also looking at the change in your long-term assets. Okay, so long-term assets, we have plant assets and the accumulated depreciation. So plant assets increase by 95,000, accumulated depreciation by 26,000. Okay, so plant assets increased by 95,000. So don't just assume that this means that they bought an asset for $95,000 of cash, and that means we are going to adjust this and say deduct 95,000 because they paid cash on that. You really have to look at the notes before you make that assumption. Here it says plant assets costing 95,000 were purchased by paying $44,000. So they paid $44,000 of cash, and they issued 5,000 common shares. So they only paid $44,000 in cash there. If you want to think about what was a journal entry that they did, they debited plant assets for the full amount, which was the 95,000. They only paid cash of 44,000, and the rest of that was to issue common shares. So then they would have credited common shares by the difference there. So 95,000 minus 44,000. Okay, so the only cash they paid on the plant assets was 44,000. So we're going to deduct 44,000 from our from our investing activities. Okay, so deduct 44,000 there for our investing activities. And we don't have any other long-term assets, we just have that one. So it's just the plant assets. So that's the only thing that's going to go into investing activities. Then let's go over to financing activities. For financing activities, we're looking at our long-term liabilities. So we have this, we have our bonds payable went down by 25,000, and then we have our shareholders' equity and retained earnings. Let's deal with the bonds payable first. If our bonds payable went down by 25,000, what would this mean? We know that there was a note about this. So it says there were no penalties assessed for the retirement of bonds. Okay, so that tells us that there was a retirement of bonds that happened. So that means that bonds were retired and the money was paid back. Right? So $25,000 of bonds were retired, no penalties or anything included in that. So that was just cash paid of $25,000. So that's going to be deducted in our financing activities. So 25,000 debt repayment or debt retirement needs to be deducted because we paid cash to get rid of our bonds payable. Then if you go over to our shareholders equity section, because the bonds payable, that's the only long-term liabilities. So let's go to our shareholders equity section. So we have common shares. Common shares increased by 55,750. Now we want to know, was there any cash included? Was there any cash that the company got or the company paid for that made up this 55,750 difference? We know that common shares of 51,000 were issued in payment for these plant assets. So we know that out of this 55,750, 51,000 had to do with purchasing the plant assets, which we didn't pay cash for that, or we didn't get cash for that 51,000. We got a plant asset. Okay, so what's remaining now is 4,750. So we need to figure out where this came from. What was this related to? And if you see, we do have a note here that says, in order to supplement cash, Gus issued $4,750 in additional common shares. Okay, so we know that they issued common shares. When common shares are issued, that means the company gets cash. So it's going to be added to our cash flow statement. So what we can do here is add that amount. So we're going to add that 4,750 amount. And then the last thing is to look at our retained earnings account. Retained earnings went up by 63,100. We know that retained earnings is affected by net income. Net income increases our retained earnings. We have 141,100 of net income. So, but retained earnings only increased by 63,100. So where did the rest of it go? So we need to figure that out. So we know that we would have increased retained earnings by 141,100 because that's the income. But we have it, the balance changed by 63,000, not 141. So there was something that had to have been deducted. Okay, so $78,000 is what we're missing here. If you go back to the notes, you see that cash dividends of $78,000 were declared and paid at the end of the year. So that is where we get the $78,000. The reason I wanted to show you this before just going into the note is if you did not get a note like this, you need to be able to figure that out, that $78,000 was deducted. When something is deducted from retained earnings, it's usually dividends. Okay, so just make the assumption that it's dividends if you don't get a note. So if this note wasn't here, which it might not have been, then do your investigation, do your calculations to see, okay, well, my income is 141,100. That would have increased retained earnings. So there's something that decreased retained earnings by 78,000. So we paid cash dividends of 78,000, therefore that is going to be deducted. Okay, so the total cash flow from financing activities is 98,250. So if we take that 155,500 minus 44,000 minus 98,250, the change in cash is 13,250. Your opening balance should be on your statement of financial position of 20,000. So show your opening balance, and then, oops, doesn't want to go zoom back out. So this is your opening balance, and then if you add the change plus the opening balance, you should get 33,250, and 33,250 is what your ending balance of cash should be. Okay, so you know what your ending amount is. So basically you know what the answer is here, and so you can figure out what the amounts were. So if you're not getting the change in cash of 13,250, then you did something wrong, and then you can go back and figure out what it was. Okay, so it tells you what the answer is, what you have to get to, and you just need to take the steps to get to it. And if you don't know, do the calculation. So you can even do it like this and say, okay, so the opening retained earnings. So if you wanted to do it like this and say, there's another way to do the calculation. So that's the opening retained earnings, and the ending retained earnings is 134,600. We know net income is going to increase it. So net income of 141. And then you kind of had to figure out why is there still a difference. So you can figure it out like that. Or you can do a T account as well to figure it out that way. Okay, so that was chapter 22, cash flows. Thank you for listening, and take care.